Welcome to Larking Gowen Insights, accountancy and business advice for all, a series that gives you bite-sized tips and guidance on tax, funding, legislation, reforms and much more. With case studies, business advisory and sector specials and even interviews, our team of experts are committed to helping you navigate the world of accounting and finance, with a variety of presenters from across our specialisms. So, let's get on with today's show.
Hello, thank you for joining us in this week's episode. My name's Gllian McGill and I'm joined by my colleague Dominic Carter. This week we're going to be talking about the budget 2025 and primarily focusing on the impact that has had on businesses. The main headline that the budget has generated has been around salary sacrifice changes and the reduction in that benefit. We're not going to talk about that in detail today, Dominic, but we are going to talk a little bit about employers and employees and the big news for you on that front.
Yes, one of the most notable changes in terms of areas that I'm involved in is in relation to the taxation of sales of shares to employee ownership trusts. So employee ownership trusts have been something that has increased significantly in popularity over the last few years. Originally introduced in 2014, uptake wasn't particularly great at the time, but as I say, there's been a significant uptick in their popularity as a means of passing a business on in recent years. That was always possible if the relevant conditions were met on effectively a CGT exempt basis. So a sale of a qualifying shareholding to an EOT where the conditions were met resulted in a 0% CGT rate effectively for the shareholders who were disposing of their shares. And that was really good, a really good way of promoting employee ownership, which is something that the previous government and I believe the current government are both very attached to. And the change that's been made this year has been in the budget. The Chancellor announced that with immediate effect, there'd only be an exemption on 50% of the gain on the sale. The remainder of the gain is taxable at normal CGT rates of 24%.
So we're talking about shareholders of a business, perhaps the husband and wife maybe who founded the business, and they want to retire, maybe don't have family that they want to pass on their shares in their company to, perhaps, or want to be altruistic, and they sell their shares to a trust, and that trust is there holding those shares for the benefit of the employees of the company. Is that right? And they were able to do that tax-free until the 25th of November.
Yeah, that is absolutely it. So the sale would be to the trust. The trust would then own the shares in the company. So it's not quite the case that it's a transfer of the shares to the employees. It's the employees, from time to time, the people who are the current employees in the business who would be the ones for whom the trustees hold those shares. And I guess really in most cases it's the fact that the business would then be run with the interests of the employees at the absolute forefront, rather than any particular impact of it being owned by the trust. But that was obviously a really good way of doing something which, when used properly, was a really positive force for encouraging employee ownership.
And so I would imagine that setting up an employee ownership trust takes an awful lot of time, many months of both legal and tax advice required, and consultation with employees and understanding the implications of everything. And this change came in on the day of the budget.
It came in on the day of the budget. So anyone who was midway through making a sale to an employee ownership trust, their disposal of shares will now attract normal rates of CGT on 50% of their gain. So no chance to plan ahead for it. And I suppose there's a couple of things to be said about that. I mean, there's the immediate impact on people who were contemplating those type of transactions. And you could say, well, 50% of a gain being fully exempt from CGT is still, total winner, isn't it? Because, you've got a very favourable effective tax rate. The difficulty with it is that many sales to EOTs are taking place on a basis which is probably more favourable to the from a purchaser perspective, and therefore less favourable to the sellers, because typically you would be selling the business for a lower price than you might be able to get if you were to sell to a third party purchaser. And in fact, I think, for reasons that are probably quite technical to go into, that following changes that were made in the budget last year, I think that will generally be the case, that it will be less than the price the business could have fetched on a sale. So there's less proceeds for the sale, also less proceeds up front, because typically these transactions are structured on a heavily deferred basis, because basically the consideration is going to be paid out not from the pockets of a corporate purchaser, but it's going to be paid out of the future profits that are generated by the business until it's all been paid. And as a result of that, most of the consideration is generally payable over 5 or 7 years, or a period of time. So the question will now be whether it's still viable for the shareholders who are selling to sell, noting that they will get a reduced purchase price, probably compared to other means of disposal, and also noting that only probably a relatively small proportion of those proceeds are going to come through on day one, and therefore the remainder of them are at risk. So that was really what the tax exemption was seeking to address, the generally less favourable basis of the sale, and compensating for that by providing a really good tax exemption. And I guess we will only find out going forward whether it will remain an attractive means of disposing of a business now that there's only 50% exempt. And of course, the way these things work for CGT purposes, the CGT is payable in the year of based on the year of disposal. So irrespective of the fact that there might be a 5-7 year period over which deferred consideration is all paid, the tax is payable in respect of the year in question. So questions about the long-term viability of it, and I hope it will remain viable, but at this point, I think the jury has to be out on that. And obviously big problems for people who are currently executing a transaction, because they would have factored in the tax exemption as an important part of making that arrangement work for them. And if that's taken away, will those sales to EOTs still go ahead, or will they have to look at alternative means of doing it? It will depend on a case-by-case basis as to whether sellers feel that it's something they can still go through with.
So pretty disappointing, really, isn't it? Because it's such a sensible and seemed to be, as you say, gaining popularity. And for this to come in overnight is normally the action that the government would take to quash some kind of tax avoidance scheme, which isn't the case at all here. But nevertheless, that's where we are.
Yeah, and I think it is really disappointing generally, because, as you say, these sort of overnight changes that are made are usually where there's some form of abusive tax avoidance arrangement happening. But and it's not only this government that's done it, it's been done, several times. If you look back to the previous government, they reduced the rate of entrepreneurs relief, the amount on which it applies, from a 10 million lifetime limit to 1 million overnight. Last budget, the Chancellor put 4% on CGT disposal proceeds with immediate effect, and this seems to be the equivalent for this year's budget in terms of immediate changes that are immediately effective, and none of them carried out for tax avoidance. And I suppose that the point that occurs to me is, and we've discussed this, Julie, in the past, that a tax change that is brought in from the start of the next year is really helpful if you're the government and if you're taxpayers, because from a taxpayer perspective, anything which is fairly imminent can generally be dealt with and got across the line before the new rate takes effect. And for government, there's a double dip, because you get the benefit of an increase in tax yields as people rush to complete transactions. So the government can say, didn't we do well? We got all these additional taxes in, and they can point to the higher rate, which is then in force, which is helpful to them in addressing any shortfall. So I do appreciate that's not quite so relevant when you're actually dealing with something which is 100% exemption. But just think what a fillip that would have been for employee ownership, to have allowed until the 6th of April, realistically, any transactions that are currently anything other than a very initial stages could have been concluded, and you would have had potentially a significant expansion of employee ownership before this came in, which I think would have been a real positive. But I think it was that the potential risk to CGT revenues over the coming years that has sort of made the government feel that they've got to do something based on the statements made in the budget.
Okay, so moving on then from employee ownership trusts, but staying on the theme of shares, we also have some changes for share exchanges, yeah?
Yes, we do. And this sounds really dull and boring to anyone who's not involved in tax, but as we know, this is something that affects lots and lots of businesses. Every time we have a business that is looking to perhaps turn itself into a group rather than a standalone company, it will carry out a share-for-share exchange normally, because that's a means of doing that without crystallising any capital gains tax when you put the extra company in. And it's the same for any form of group reorganisation or a demerger or anything like that. These provisions are relied on by businesses, companies, restructuring, all of the time, really. But I am pleased to say that the changes that have been made there seem like they are significantly less impactful, and may not be a wholly bad thing. They really relate to the fact that there has always been an anti-avoidance test. In other words, if the transaction was not carried out for bona fide commercial reasons, or if it was carried out to avoid certain taxes, HMRC could step in and basically say, well, the share-for-share treatment won't apply. We are going to treat you as though you have made an actual disposal of shares and acquired other shares. And the taxpayers always had the option of going to HMRC in advance of the transaction to say, okay, we need certainty on this transaction. Can you confirm in these circumstances that this is your view of it? Nothing's being done that's done other than for commercial reasons.
Yeah, that means that there'd be no tax arising if it were a genuine share-for-share exchange, rather than
that's right.
Tax arising on the disposal, as it might be seen.
That's exactly right. So if I've got my standalone company and I want to turn it into a group, probably what I want to do is start that process off by putting a new company in over the top of my group. I could put a company in underneath, but then I probably would want to transfer all of my trade and business downstream, and that would be very complicated. So normally I put a new holding company in place, and I do that by exchanging my shares in the existing company for shares in the new company, and then they are 100% parent subsidiary. And the tax rules recognise that I'm not getting any money out of that. It's a completely neutral transaction in terms of me taking any money out of the business, and therefore to help me and my business expand appropriately, I should be able to do that without there being any CGT. That's what the rules allow for. There's anti-avoidance rules, as we said, which block them from applying in certain circumstances. And I've also got the opportunity to ask HMRC to confirm that they're not going to invoke those, and they won't where the transaction is commercially motivated.
So your new test is what now?
Yeah, the new test is going from bona fide commercial reasons and not the avoidance of certain taxes to there being a tax advantage motive, effectively. So that might sound a bit of a nuance. It doesn't sound like it's a massive change. And reality is we won't know for a while until we see how HMRC start to respond to these. So potential impact, massive, because it affects a huge range of corporate transactions. Actual impact, we'll have to wait and see. I am actually quite optimistic on this one because I think HMRC have got certain sort of situations in mind. Most of the times when we're applying for clearance from HMRC, we are actually applying under a couple of provisions, one of them being this one, and another one being what is called the transactions in securities legislation, and that has a test that is based on income tax advantage. So normally, the revenue will either reject your clearance, or hopefully when you're applying for a clearance on a bona fide commercial transaction, they will give you clearance under both provisions. I would be surprised if it has a drastic impact on our experience and businesses' experiences of applying to HMRC for tax clearance. But it could potentially it'll affect a wide number of transactions. I guess the really important thing is for anyone who's in a position where they have already applied for and secured a tax clearance would be to make sure that they execute those transactions within 60 days of the budget, which is the time scale HMRC have allowed, where the benefit of prior clearances are going to be
So we're talking
grandfathered
before the end of January, aren't we?
Exactly that, yes, yeah, and that's quite reasonable, really, for them to have allowed that sort of time. We shouldn't really be applying for that type of clearance further out than that, or it's all sort of a bit speculative, and HMRC understandably don't like you doing that. But there will be transactions that have been held up, and in that case it will be a question of assessing whether it'd be appropriate to go back to HMRC and ask them for confirmation that the situation or their view of the transaction under the new rules is no different to what it was under the old rules, and for them to grant new clearance under the new provisions. But I've got a few transactions that I'll be trying to make sure come through in good time.
It's an odd one because, as you say, it sounds like a very nuanced change, in which case why bother making it? So it will be interesting to see what HMRC's response to clearances with the new regime looks like.
Which could be more or less favourable. But I would suspect that we're operating in the mainstream, really, aren't we? And our clients are generally operating in the mainstream. There may be arrangements of which they're aware. There certainly have been tax cases which have explored these sort of concepts. So I think they've got something pretty clearly in mind that they're looking to address. I would personally be surprised if many of our clients and the businesses we work with are going to be adversely impacted, but there is a need to conclude transactions in relatively short order if you do currently have a clearance.
Noted. Okay. Anything else from you? Anything on corporation tax specifically?
Well, I think really there have been changes in relation to corporation tax, but what I am pleased with is the fact that, having published the corporate tax roadmap last year, the government have aimed pretty much to keep corporation tax, of course not the only tax that affects businesses, but as far as corporation tax is concerned, they've tried to really maintain some consistency. They made a pretty clear statement that some of the most favourable aspects of the UK's tax system, corporate tax system, are going to remain in place, and they have stuck to that in this year's budget as well. So a relative lack of change, generally speaking. There are changes that will impact certain types of business doing certain transactions. For example, the long-awaited response to the various consultations on certain aspects of the taxation of larger corporates and international businesses has come through. Again, nothing earth-shattering there, but important detail if you are your business is affected by them. I guess more mainstream. What have we got? We have got small changes to the capital allowance regime, introduction of a 40% first year allowance, albeit given all of the other allowances which are available, it takes a bit of thinking to work out who's actually going to be able to use that. But again, that's a good thing because the capital allowance system is generally pretty favourable as a result of changes that the governments have made over the last 3 or 4 years. So that's in fairly good shape, and I think they're aware they need to maintain these aspects of the tax system to help the competitiveness of the UK.
Yeah, and on that sort of theme of certainty and mapping the way out, in VAT we've had a very light touch in this year's budget, which has been most welcome indeed, without, I suppose, our big headline issue being confirmation that electronic invoicing is going to be mandated in the coming years. So we are, or I am, casting my mind back 4 years to when Making Tax Digital for VAT was implemented, and the disruption that created, and anticipating that that's what we might well see over the next 3 to 4 years for electronic invoicing. We're having a consultation coming out early next year. We'll know a little bit more about it at next year's budget 2026, when I think we're going to get a roadmap. So it's useful to know that the government stuck to their corporate tax roadmap. Hopefully they will stick to their e-invoicing roadmap when the time comes for that as well. But it's
Everybody
going to be
likes a good roadmap, don't they?
They do, yes. It's definitely going to be a big one. I think for anybody but the very largest companies, this is going to be a very big investment, and quite disruptive indeed to their operating on a day-to-day basis. So hopefully HMRC will be listening to the consultation responses when they come in next year.
So, I mean, Julie, if I'm running a business and I'm going to be impacted by that, when's the realistic earliest that I would be directly impacted by the changes, and when would I need to start thinking about this, and how could you help me?
Well, at the moment we're looking at mandation from April 2029. Now, whether that's only going to be for the large corporates and then it will over time be trickled down to smaller enterprises, don't know. Also, again, thinking back to Making Tax Digital days, that target date did shift a couple of times. So whether April 2029 will happen or not remains to be seen. However, I think once we've got the roadmap next year, we'll have a clearer idea of whether that is actually achievable and whether it's going to be 100% of businesses in wave 1 or not. We need to start working with businesses to ensure they're aware this is coming. That's the first thing. They've got their head around what it actually means, because it's going to require some new software to have suppliers talking directly to customers, accounting systems. And they're going to have to understand how that then impacts their current processes for processing purchase invoices and sales invoice, for example. How are they going to make sure that they are correct, that, they're addressed to the correct person, they've got VAT charged at the correct rate? Because as we know, if you charge VAT at the correct rate, it causes a whole world of problem for your customers and for you as well. So there's going to have to be a whole review of systems and coding and making sure that everything is set up correctly and smartly, so that electronic invoicing will work slickly when the time comes.
And do you think, I'm looking to the dim and distant future here, but do you think it will be a helpful development when it comes in? Would it help to reduce sort of fraud? If
Yes.
I'm, as of course I would be, operating a fully genuine bona fide business that's seeking to comply with all relevant laws and regulations, overall, would it be a good thing for me in terms of making sure that everybody else is playing by those same rules?
Definitely. I think that is one of the main advantages of having an electronic invoicing system. If we, in fairness, a lot of countries have already got this. We are in no means at the forefront of this development. And if we think about the list of countries who already have an e-invoicing system, they include some South American countries and Mediterranean countries where historically, tax compliance has not been great. And this has been shown to help stop the tax leakage. So it should be a positive thing. It should increase tax intake for the government. What it might do, though, is effectively introduce an element of AI type processes into the system, which eventually would allow HMRC to have a direct view of and immediate view of transactions, and that would enable them, in theory, to raise queries in real time for transactions, not waiting for VAT returns to be submitted. Now, whether you view that as a good thing or a bad thing depends on where you're coming from, I guess.
Get your HMRC inquiry in real time rather than, in retrospect after you filed your return.
Yeah, definitely.
So what you described there, Julie, was quite similar with making tax digital, wasn't it? We've got certain, potentially stereotypical views about which countries in the world will be more advanced than the UK, quicker adopters of new technologies and processes, and which ones might be slower. And I was struck with making tax digital that we were sort of 15 or 20 years behind certain Latin American countries in their adoption of it. And it sounds like it's the same here, really. And I'd like to think that if it can be managed by other nations around the world, that it's something that could operate effectively in the UK as well. But it sounds like it will be a huge upheaval actually getting to that point.
I think it's just the implementation. Once it's up and running, like most things, it will just become the new normal, won't it? But yeah, there'll be a bit of upheaval and a little bit of consternation until we know exactly how it's going to work and what HMRC are expecting from businesses, I think. But that was the big one for VAT, although not really VAT relevant, but it's sits within our sphere. We only, other than that, had some small little bits and bobs around the edges. Some really good news as a result of consultation in that businesses can now zero rate the donation of goods to charities up to certain limits, £100 generally, £200 for particular items. Those tend to be sort of white goods or electronics, that kind of thing. But in the past, businesses should have been accounting for standard rate VAT on those donations. Now, whether they were or weren't, neither here nor there. The point is that those are now zero rated, so we've got comfort and or the VAT relieved for businesses who want to donate to charities, which is great news.
That is good, isn't it? So no change in the VAT threshold, no change in the VAT rate.
No.
All of these things that were potentially talked about when it was thought the Chancellor had a bigger
black
hole to fill than she potentially did. But and are there things that you would have liked to have seen that you didn't see, Julie, given that not that much happened?
Well, I think it's a little bit disappointing that the Brexit payoff has been relatively limited, bearing in mind that now we're able to, in theory, play around with zero rate relief a lot more than we could whilst we were part of the European Union. That hasn't really been extended a great deal, apart, I've just mentioned zero rating for donations to charities, which is a good one. But that really is a fairly small bit of tinkering. We've got a consultation being released by HMRC, which seems to be their new favourite thing to do, which is going to look at the VAT treatment of land that is earmarked for development of social housing. And the rumour is at the moment that the thinking will be that that land can be zero rated, which would be fabulous news. So that may be my favourite thing if it comes to pass when we get there. At the moment, if you are selling land for development, regardless of whether it's for social housing or not, is either standard rated if you've opted to tax, so you're going to have to charge VAT and account for VAT on that sale, or if you're selling to a housing association, it could be exempt, and that then prevents the seller from recovering VAT. So it's not terribly attractive either, whereas a zero rate, if that is what is being contemplated, would be fabulous. So hopefully that consultation will be as well carried out as the one on donations to charities, and we'll get a good result.
You'd like to think that with the government's commitment to development, that would be something that would be a realistic possibility.
Yeah, let's hope. So it's all good news, I think, Dominic, on the business side anyway, apart from your surprise on employee ownership trusts and the bombshell of overnight tax charges arising on those. Thank you very much for joining me. If you want to get any more information or get in touch with Larking Gowen, please see the details in the show notes. Thank you.
Thank you for joining us for Larking Gowen Insights, Accountancy and Business Advice for All. Don't forget, you can find more information about today's topic and more about how our team of experts can help you in your business by visiting our website, larking-gowen.co.uk. Join us again next time for another fascinating insight into the world of accounting and finance.